Welcome to Facts Not Forecasts, your daily edge in the stock market, facts, insights, and opportunities you won't hear anywhere else. Today, we're doing a deep dive into the world of fintech, but with a specific lens. It feels like every conversation right now is dominated by the next big AI play, right? But we believe there's a powerful narrative unfolding in established financial businesses. The ones that are evolving, innovating, and quietly offering real value. We want to ask you, our listener, are you solely focused on the AI giants, or are you maybe scouting for robust opportunities in the real financial companies that underpin our economy?
Yeah, that's precisely our mission for this deep dive. We're going to examine three significant players, PayPal, Robinhood, and Interactive Brokers, with a data-driven approach, really drawing insights from all our sources. The goal is to cut through the hype, understand their fundamental strengths and risks, and hopefully uncover genuine opportunities for you in a sector that, well, might not be as flashy as AI, but it's arguably far more tangible. We'll look at the numbers, what they truly mean, and why they matter for your investment strategy.
Okay, let's unpack our first contender, PayPal.pypl. It's a name most of us know, probably use it almost daily, right? Online shopping, sending money. But behind that familiar interface, is this digital payments giant still innovating? Or is it, trying to hold its ground against a new wave of competitors? What's the core of their business, and how exactly do they make their money these days?
Well, at its heart, PayPal is the technology platform that makes digital payments happen worldwide. It's a really vast ecosystem. It includes familiar names like PayPal itself, Venmo for peer-to-peer stuff, and Braintree, which powers payments for countless online merchants, their primary revenue driver. That comes from transaction-based services. So essentially, they earn a small fee every time money moves through their system. But it's not just about transactions. They also generate significant income from value-added services, interest from consumer and merchant loans, and various credit products. It's a broad, integrated approach to digital finance. That's really how they became such a powerhouse.
Okay. And looking at their recent financials, Q2 2025 specifically, how are they actually performing, especially with all these competitors, nipping at their heels?
Yeah, it's interesting. What's truly fascinating in our sources is that PayPal delivered pretty solid financial performance despite that competitive landscape. They reported total revenue of $8.29 billion. That marks a healthy 5.4% increase year over year.
Okay, 5.4%.
And their net income saw an impressive jump, 14.88% quarter over quarter, reaching $1.26 billion. They even beat analyst estimates for non-GAAP EPS, which, for listeners, that basically strips out certain non-recurring or non-cash items to give a clearer picture of operational profitability.
Right, the underlying profit.
Exactly. They came in at $1.40 per share, surpassing expectations by almost 8%. Now, 14.5% profit margin is respectable, definitely. But for a market leader like PayPal, it also tells us they're operating in a fiercely competitive space where margins are constantly under pressure. It's not like the early days.
Those are strong numbers on the surface, yeah. But in a world changing this fast, what about their growth prospects? Where is PayPal looking to expand, find new opportunities?
Well, their growth is driven by several factors we've seen highlighted across the sources. Total payment volume, PPV, that's the total value of all transactions, right? It hit $444 billion in Q2 2025. That's up 6.4% year over year.
Wow, $444 billion.
It's huge. And Venmo, in particular, continues to be a growth engine. Its TPV increased by 12% year over year to nearly $82 billion. It's easy to get lost in these billions, I know. But remember, each one of those transactions often represents someone buying a coffee, paying a friend back, or, a small business making a sale. It's easy to forget that human element looking at spreadsheets.
Good point.
Looking ahead, PayPal actually raised its guidance for transaction margin dollars and non-GAAP EPS for fiscal year 2025. And they reaffirmed free cash flow guidance between $6 billion and $7 billion. So they're projecting strong cash generation. Their strategic focus includes strengthening Venmo's offerings, enhancing their branded checkout experience, expanding value-added services. They're also exploring AI-driven commerce and advertising, and pushing cross-border features like PYUSD.
So it sounds like they're making a strong push on multiple fronts, trying to evolve, definitely not standing still. But what about the risks? And how does their valuation look in the market today? Are investors seeing what we're seeing here?
Yeah, that raises an important question for potential investors, doesn't it? As of September 5th, 2025, PayPal's current price is around $68.26. Its trailing 12-month PE ratio, so over the last 4 quarters, is around 14.5 to 14.66. The forward PE is about 11.72.
That seems pretty reasonable compared to others in the space, no.
It does suggest a relatively attractive valuation compared to some high-growth peers.
Yeah.
It indicates the market might be overlooking some of its turnaround potential, perhaps. Analysts seem generally positive. 19 out of 42 recommend a buy, and the average price target implies over 21% upside. Some estimates even suggest it's significantly undervalued. However, there are notable challenges. The stock is down 18% year-to-date. That suggests market skepticism, despite the positive earnings report.
Right.
And there was recent news. German banks blocking over $10 billion in PayPal payments due to fraud concerns. That's a big operational headache.
Ouch.
Yeah. Adjusted free cash flow was down a significant 42% year-over-year in Q2 2025. That's a big drop.
42%. Wow.
Yeah. And overall payment transaction volume actually declined 5% year-over-year, partly due to softness in Braintree. And intriguingly, we also observed significant insider selling over the past 3 months. That's always something to keep an eye on, when management's selling shares.
Okay, so PayPal, working hard to evolve its massive ecosystem, facing some headwinds, but maybe undervalued. Got it. Now, what about a player that completely, redefined the game for retail investors? Let's talk Robinhood. A platform that really changed things, especially after that whole meme stock era. What's the latest with them? How are they charting a course now?
RobinHood Markets, Inc. Yeah, they remain a fascinating player in this fintech space. It's a financial services platform that essentially democratized access to trading, right? For U.S.-listed stocks, ETFs, options, gold, crypto. They've consistently pushed innovation, offering features like fractional trading, recurring investments, retirement programs, even instant withdrawals, all designed to make investing more accessible.
Yeah, they definitely lowered the barrier to entry.
Hugely. And in a major development, Robinhood is set to join the S&P 500 on September 22, 2025. They're replacing Caesars Entertainment.
Wow, Robinhood in the S&P 500, that's a huge milestone, isn't it?
It's a massive stamp of legitimacy for a company that started out, pretty controversially, and it often signals increased institutional investment and liquidity down the line.
Right. How has this translated to their recent performance and growth, especially after the frenzy of the meme stock era kind of faded? Are these numbers sustainable or just a bounce?
Well, their Q2 2025 performance, according to our sources, was quite robust. It really points to sustained momentum, actually. Total net revenues surged an impressive 45% year-over-year, hitting $989 million.
45% year over year, that's huge.
It is. And what's more, their net income more than doubled, up 105% year-over-year to $386 million. They saw strong customer growth, too. Funded customers increased 10% to 26.5 million. And Robinhood Gold subscribers, they jumped an astounding 76% to 3.5 million.
So people are paying for the premium service.
Exactly. It indicates the strategy is resonating. Total platform assets nearly doubled as well, up 99% year-over-year to $279 billion. Robinhood's also exploring new avenues like prediction markets and continues to invest in international expansion. Even regulatory bodies like the SEC and CFTC are working on rules for 24-hour trading and event contracts. That could open up significant new opportunities for brokers like Robinhood.
Okay, that growth is explosive, no doubt. But with those kinds of valuation multiples, a PE around 50, it feels like the market is baking in perfection, doesn't it? Is there enough room for error with those expectations, especially for a company with such high volatility? What are the risks lurking beneath the surface that we should be aware of?
That's a really sharp question, and you're right to ask it. Currently, Robinhood is trading around $101.25 as of September 5th. Its trailing PE ratio is high, around 51 to 52, and its price-to-sales ratio is 25.08.
25, wow.
A PS ratio that high compared to its peers really indicates strong expectations for massive future revenue growth. It's pricing in a lot of future success right now, kind of a blue sky scenario baked in. The profitability margins are excellent, though. Gross margin over 88%, operating margin 42.82%, profit margin nearly 50%. EPS grew over 500% year-over-year. That's impressive.
Huge turnaround.
Huge. But you're right to point out the risks. Robinhood has a high beta, ranging from 2.36 to 3.12. That high beta isn't just a number. It means Robinhood's stock price historically swings significantly more than the overall market.
So bigger ups, bigger downs.
Precisely. For investors, this translates to both higher potential gains and higher potential losses. It's a distinctly different risk profile than, say, PayPal. We've also noticed a clear trend of insider selling over the last quarter, which merits attention, just like with PayPal. Also, their expense outlook does include provisions for credit losses, costs related to pending acquisitions like WonderFi, or potential significant regulatory matters. All of those could impact future financials.
Things lurking, potentially.
Potentially.
Yeah.
And their debt-to-equity ratio is also quite high at 159.5%.
Okay, so Robinhood. Explosive growth, S&P inclusion, but high valuation and significant volatility. A different beast entirely. Now, let's turn our attention to interactive brokers, IBKR. They're often seen as a more maybe sophisticated player in the brokerage space, right? Catering to a different crowd.
Yeah.
What makes them a compelling choice, and how do they differentiate themselves from the likes of Robinhood?
Interactive Brokers Group, Inc. Yeah, they're truly a global brokerage powerhouse. They operate as an investment holding company with both broker-dealer and proprietary trading businesses. They serve a really wide array of clients, from hedge funds and mutual funds all the way to individual investors with substantial portfolios.
So not just retail.
Not just retail, though they serve them too. Their strength really lies in their extensive global footprint. For instance, they recently launched zero-commission U.S. stock trading in Singapore. That not only expands their international reach, but also shows their adaptability to local market demands. This diversified global approach provides a pretty robust foundation.
It sounds like they have a very diverse client base and global presence. How does that translate into their growth, especially with their recent inclusion in the S&P 500 as well? What kind of impact does that typically have?
Yeah, that S&P 500 inclusion, which happened August 28, 2025, replacing Walgreens, is another significant validation, just like for Robinhood. It means passive index funds will now buy their stock, providing a steady base of demand, generally speaking.
Right, the index effect.
Exactly. Connecting this to the bigger picture, their growth is quite steady. It seems driven by underlying trust in their platform. They reported continued customer account growth in August 2025. And earnings are forecast to grow by over 11% per year, having already grown 23.1% over the past year.
Solid numbers.
Pretty solid. They're also innovating with products like their Connections tool for smarter investment discovery, which helps investors find opportunities based on their preferences. Record client balances and consistent new account growth really demonstrate strong trust in their platform. That suggests continued expansion in both their retail and institutional segments.
Okay. And what about their financial health and valuation? Are there any red flags there, particularly given the amount of debt we sometimes see in financial institutions?
Good question. As of September 5th, Interactive Brokers is priced at $60.16. Their trailing PE ratio stands at 31.55, with a forward PE of 27.84.
So higher than PayPal, lower than Robinhood, kind of in the middle.
Exactly. It suggests less aggressive growth expectations than Robinhood, but still indicates solid growth prospects, more so than perhaps PayPal's multiple implies. The profitability is excellent. Gross margin of 94.25%, operating margin 84.11%, very efficient operations. Though their profit margin of 8.59% is lower, likely due to their specific operational structure or investments. Earnings per share for the trailing 12 months grew 20.76%.
Still strong growth.
Definitely. Analysts give them an average price target of $68.50, and Simply Wallerstein estimates them to be around 9.2% undervalued based on consensus. However, like the others, we see patterns of insider selling in recent months here as well. It seems to be a theme.
Yeah, interesting.
Their debt-to-equity ratio is 4.43. And one of our sources even notes insufficient data to determine if IBKR's interest payments on its debt are well covered by EBIT. That's a detail savvy investors should definitely look into further if they're considering a position. And the stock was also down 6.41% on September 5th, just highlighting that even established players have short-term volatility.
Okay, so we have three distinct fintech players here: PayPal, Robinhood, Interactive Brokers. When we look at their fundamentals, their valuations, how do they stack up? Not just against each other, but maybe conceptually against some of these high-flying AI stocks we hear so much about?
Yeah, that's a critical comparison to make, and our sources highlight some really stark differences. If we look at their PE ratios, PayPal stands out around 14.6, right? Significantly lower than Interactive Brokers at 31.55, and Robinhood way up there at 51.43.
Huge spread.
Massive spread. Similarly, for price to sales, PayPal's at 2.02, Interactive Brokers at 2.75, and Robinhood jumps way up to 25.08. These widely different PE and PS ratios, they tell a story about market confidence and expectations.
Yeah.
PayPal, the mature player, is largely valued on current earnings, its steady cash flow. Robinhood, however, with its much higher multiples, is clearly a growth story. Investors are betting heavily on massive future potential that, may or may not materialize, pricing in a lot of that blue sky scenario we mentioned.
Right. And in terms of actual growth beyond just market expectations, how do those numbers shake out between them?
Well, for recent EPS growth year over year, trailing 12 months, Robinhood leads significantly. That incredible 508.72% reflects that major turnaround.
Yeah.
Then Interactive Brokers at 20.76% and PayPal at 13.85%. Sales growth also shows Robinhood leading at 58.58%, then Interactive Brokers at 12.3% and PayPal lagging a bit there at 4.05%. However, when we look at estimated EPS growth for next year, Interactive Brokers and PayPal are in a similar range, around 11% and 10.8% respectively. Robinhood shows varied expectations, anywhere from about 4% to nearly 14%, depending on the source. So less consensus there.
Interesting discrepancy.
It is. What's also notable is volatility. Robinhood has that much higher beta, between 2.36 and 3.4. That makes it considerably more volatile than PayPal or Interactive Brokers, which hover around 1.2 to 1.4.
So Robinhood's price swings are just much more pronounced. Higher reward, higher risk baked in.
Exactly. Presenting both higher reward and higher risk.
It's clear they have very different risk-reward profiles. And the S&P 500 inclusion. That's something both Robinhood and Interactive Brokers share recently, while PayPal's a long-standing member. How does that factor into our conceptual comparison to AI stocks?
Right. Both Robinhood and Interactive Brokers recently achieved S&P 500 inclusion. That's a strong signal of maturity, a positive catalyst for institutional investment. PayPal, of course, is already well established in the S&P 500 and Nasdaq Q100. This kind of broad market acceptance is a major differentiator. Now, while we observed insider selling across all three, it's not necessarily a uniform red flag, as we touched on. For a high-growth, newly S&P included company like Robinhood, maybe it's executives cashing in after a long-awaited milestone. Understandable, perhaps.
Right.
For PayPal, however, especially amidst a turnaround effort and those performance challenges, it could signal a more cautious internal outlook. Needs more context. The key distinction here, compared to some AI-driven companies, is that these fintechs have established revenue-generating business models and often demonstrated profitability. They offer more grounded investment proposition, generally, than purely speculative plays built only on future narratives.
So what does this all mean for someone listening, someone looking to invest beyond the immediate AI excitement? Which of these fintech stocks, based on our deep dive into the sources, presents the most compelling opportunity for you, the listener? And what are the absolute key risks to keep an eye on?
Well, these three companies really represent diverse, tangible aspects of fintech, right? Digital payments, brokerage services, they all have clear revenue generation and active user bases. That's a stark contrast to some highly speculative, maybe nascent AI ventures whose revenue models are still evolving or unproven. So for a value-oriented investor, PayPal looks quite appealing on the surface. Its lower valuation multiples, that robust free cash flow guidance despite the recent drop, and the continued growth in its core TPV and Venmo. It presents an interesting prospect. Its strategic focus on branded checkout and value-added services seems to be paying off in its turnaround efforts. That suggests potential for a re-rating if the execution continues.
Okay, so PayPal for the value conscious, maybe?
Perhaps. Then, for growth-focused investors who are comfortable with higher volatility, Robinhood presents a compelling case. Its explosive growth in customer engagement, gold subscribers, platform assets. It's undeniable. S&P 500 inclusion and diversification into areas like event contracts suggests strong potential for continued expansion and mainstream acceptance. However, that higher valuation and the insider selling demand careful consideration. The market is expecting near perfection there.
High growth, high expectations, high risk.
Pretty much sums it up. And then Interactive Brokers offers a more balanced profile, growth and established presence. With solid profitability, consistent account growth, and its own S&P 500 inclusion, it could be seen as a more conservative yet still expanding choice within the fintech sector. Its focus on product innovation like the Connections tool also adds to its long-term appeal, especially for more sophisticated investors.
It sounds like each really does offer something different depending on an investor's goals and risk appetite. What are the absolute critical risks to watch across the board, the things that could truly disrupt the thesis for any of these?
Okay, critical risks. For PayPal, you must closely monitor the persistent insider selling in shape. It's a signal that just can't be ignored easily. That significant drop in adjusted free cash flow year over year is also a potential red flag for fundamental health. And operational challenges, like those German fraud concerns, could impact trust and efficiency. Plus, that overall decline in payment transaction volume in some areas needs watching for signs of market share erosion.
Got it. PayPal risks noted.
With Robinhood, the high stock volatility means your investment could swing wildly. Be prepared for that. and its demanding valuation multiples imply very high expectations are already priced in. Remember, their expense guidance excludes potential big hits like credit losses, acquisition costs, or major regulatory matters. Those could emerge as unforeseen costs down the road.
Understood. Robinhood, volatility and high expectations.
And for interactive brokers, while fundamentally strong, the insider selling is also present there. And that note about insufficient data for interest coverage on its debt in one source, that warrants deeper investigation for anyone looking closely at their balance sheet. Don't just gloss over that. Plus, their global presence exposes them to different regulatory and geopolitical risks that a more U.S.-focused company might face.
Okay. A critical takeaway for investors then seems to be that while these companies operate in the same broad fintech space, their individual growth drivers, their risk profiles, their valuations, they paint very different pictures. And that's exactly what a deep dive like this is for, isn't it? Understanding the nuances beyond the headlines, allowing you, the listener, to make more informed decisions rather than just chasing the latest buzzword.
Absolutely. And remember, the fintech landscape is constantly evolving. It's driven by innovation, yes, but also subject to market forces and regulatory changes. Staying informed on these established players, understanding their fundamentals, appreciating their distinct positions, that's key to spotting genuine opportunities beyond the daily headlines.
Well, we hope this deep dive into PayPal, Robinhood, and interactive brokers has given you valuable insights into the opportunities available in real financial businesses, maybe away from some of that immediate AI frenzy. We'll definitely be keeping a close eye on these companies, especially post earnings in October. Make sure you subscribe so you don't miss our next update. Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.